Hello, if I ask you right now, what does a business actually own? What does it owe and how much of it is really yours? Most business owners, especially when they're just starting out, can't answer these three questions clearly because they never pay attention to them. Welcome to Triple P Solutions. I'm Buki, and in this episode, I'll walk you through the three financial concepts that every business owner must understand to answer these questions: assets, liabilities, and equity. Whether you're a sole trader, a freelancer, or someone who have just started a company, by the end of this video, you will know exactly what these three concepts are and what they tell you about the financial health of a business. Let's get into it. When you are starting out in business, either as a plumber, a sole trader, consultant, you are focused on one thing: getting the client, doing the job, and getting paid, and that's completely understandable. But here's one thing most new business owners don't realize. From the moment your business starts trading, even on day one, your business has a financial structure. It has the things it owns, the thing it owes, and the value that belongs to you, the owner. Understanding the financial structure of your business is what keeps you in control. And here is the practical reason why this matters. If you ever apply for a business loan, your banker or lender will request your financial structure. If you ever want to bring in a partner or investor, they will ask for your financial structure. If you ever want to sell your business, it is very critical to how the value is being calculated. And even for your own peace of mind, knowing what you own, what you owe, and how much is genuinely yours is one of the most empowering things a business owner can understand. So let's start with the first concept: assets. An asset is defined as a present economic resource controlled by an entity as a result of past events and from which it can generate future economic benefits. Simply put, an asset is something your business owns or controls that has value. If you are a plumber or a trade person, your van is your asset. Your tools are your assets. The money in your business bank account, those are also your assets. If you're a freelancer or a consultant, your laptop is your asset. The money your clients owe you even when they've not paid you are also your assets. It's called debtors or trade receivable. If you sell products, your stock or inventory is an asset. Add all this up, that's the total assets of your business. And that's where your financial position starts. Now, assets fall into two broad categories, and understanding the difference is very important. We have the current assets and the non-current assets. Current assets are often called the short-term assets, and these are assets that are easily convertible into cash and may be used up within 12 months. Example is your cash in your business bank accounts, the money customer owe you, that is your debtors, the stock or inventory you plan to sell soon. And your non-current assets, which are also referred to as long-term assets, are those assets that you own and use to generate revenue for more than a year. Your van, tools, equipment, your business premises, if you hold them, those are your long-term assets. Short-term assets are what keep your business running day to day. If they dry up, then your business will hit a cash flow problem, even if you own a lot of long-term assets. Now, let's move on. Liabilities. A liability is simply something your business owns to someone else. An example is a loan on your van. If you have an overdraft on your business bank account, those are liabilities. A payment plan on a piece of equipment that you are using in your business, those are also your liabilities. And unpaid supplier invoice are also your liabilities. And like assets, liabilities are also split into two types. We have the current liabilities and the non-current liabilities. The current liabilities are also called the short-term liabilities, and they are the things that need to be paid within a period of 12 months. And please watch those closely. Example is your supplier invoice that you are here to settle, your tax bill, your overdraft on your business bank account. Those are your current liabilities. And your non-current liabilities are also called the long-term liabilities, and these are the ones that fall due over a period of 1 year and above. If you have an hire purchase plan on a vehicle or anything in your business, those are your long-term liabilities. And every business has liabilities, and that's completely normal. The question is not whether you have liabilities, but how do you manage them? Here's a trap most new business owners fall into: the short-term liabilities, the ones that falls due within a period of 12 months. And that's where the cash flow problem reside. A business can look profitable on paper and still run out of cash if those liabilities falls you at the wrong moment. Always know what to owe and when they fall due. Now, this is one that puts everything together. Equity. Equity is the portion of your business that genuinely belongs to you. It's what you have left if you sold all your business owns and paid off all its owes. An easiest way to understand this is through a simple analogy. Imagine you have a mortgage worth £200,000 and you have an outstanding balance of £120,000. The equity in your house is the part that is genuinely yours. That is £80,000. Your business works in exactly the same way. Asset equals everything your business owns. Liability is what it owes, and equity, the part that is left, that's what belongs to you. Assets minus liabilities equals equity. That's an accounting equation. And that's the financial foundation of every business in the world, including yours. So let's put some real numbers to it. And here is a worked example of a sole trader's balance sheet. So this sole trader has a van worth £15,000, tools and equipment £3,000, cash in the bank £5,000, money clients owe to the trader, that's the debtor, £2,000. If you had this, of the total asset of this sole trader is £25,000. And let's go to the other sets of numbers. We have loan on the van, which is £8,000. We have unpaid supplier invoices worth £1,500. Tax owed to HMRC £2,500. And if you sum it up, its total liabilities is £12,000. Now, what is its equity? That is what value belongs to the owner. So remember, we said assets minus liabilities equals equity. So if we had total asset of £24,000, take out the liabilities of £12,000, then this sole trader equity is £13,000. The equity is the value they have built in a business over time. And here is what makes equity so important. Every year, your business makes a profit and you don't take all of it out. The remaining profit stays in the business. That leftover profit is called retained profit or retained earnings. It adds to your equity, and growing equity year on year in is one of the clearest signs that your business is genuinely building value, not just generating activity. Every business has the same financial structure: asset on one side, liabilities and equity on the other side, and they always balance. Asset equals liabilities plus equity. Every asset in your business was financed by someone. It's either financed by a lender, which creates a liability, or by you, the owner, through money you put in or profit you've kept, which builds your equity. If your equity is growing year on year, your business is genuinely building value that is worth owning, and that's number to watch. This relationship is recorded in something we call the balance sheet, or more formally, the statement of financial position. It's a snapshot of your business at a single point in time, what it owns, what it owes, and what belongs to you. Now, I want to give you 3 simple signs to watch, especially at an early stage of your business. Warning sign 1, when your liabilities are bigger than your assets, this means your business is technically owing more than it owns. It's called negative equity, and that's a serious one. If you're a sole trader, this can also put your personal finances at risk. Act immediately, speak to a professional. And the warning sign 2, your liabilities are growing faster than your assets. You are taking on more debt, but what you own isn't keeping pace. Watch this closely. It can become a problem quickly if revenue slows down. And the one you want to see is when your equity is growing year on year. It means the business is building genuine value for you. You are keeping more than you are owing, and that's financial strength at any stage. Before I close, here are 3 simple actions I want you to take now. Action 1, write down your assets. Grab a piece of paper or a spreadsheet. List everything your business owns: your vehicle, your equipment, your cash balance. Any money customers owe you, put a rough value next to each one. You now have your asset list. And the action 2, write down your liabilities. List everything your business owes: your loan balance, your unpaid supplier invoices, tax due, any finance agreements you have. Total this up, you now have a liability list. And action 3, calculate your equity. Subtract your total liabilities from your total assets. The number you get is your equity. the financial value your business has built over time. If it's growing each time you check it, then you are moving in the right direction. That's your first balance sheet. It doesn't need to be a perfect one, it just needs to exist. Because you cannot manage what you cannot see. Assets, liabilities, equity. 3 words. One simple structure, the financial foundation of every business in the world, including yours. Assets are what your business owns and control. Liabilities are what it owes to others. And equity is what belongs to you, the value you are building for yourself as a business owner. Understanding these 3 things, even at a very basic level, put you ahead of most business owners who are simply going through the motions without ever looking at the full financial picture. And at Triple P Solution, this is exactly what we help business owners do. We help you understand your numbers in plain language so you can make better decisions and build a business that genuinely works for you. Thank you, and I'll see you in the next episode.